Hi everyone. So US is about to cut its interest rate structurally. So it's expected that there are going to be multiple interest rate cuts this year. This is going to have a positive impact on the stock markets, both Indian stock markets, US stock markets. Bitcoin is going to go up. Gold is going to continue to go up. Now, does it mean that you should be buying these assets, not buying these assets? I'll give a quick commentary on this entire topic. If you watch this video till the very end, you will have a very clear understanding why these interest cuts are happening, how it will impact the economy, and how you should go about restructuring your portfolio. Or in case you're looking to make more investments, you can make a call whether or not this is the right time to do it. So first things first, here is the interest rate chart. And if you consider this, right, this is the last 5-year data for US interest rates. Now, whenever US decides to change its interest rate policies, other countries typically follow that, including that in India. So for example, between 2022 and 2024, the US increased the interest rate. This led to something called as 2022 crash, right? So the markets corrected in India also. The markets corrected in the US also. So whenever interest rates are typically jacked up dramatically, there is a negative impact on the stock market, generally speaking. And whenever interest rates are brought down, right, there is a positive impact on stocks. So this is a point that I'll speak subsequently, but the general commentary here is that, see, number one, between 2022 and 2023, the interest rates were increased dramatically. Why? Because at that point in time, there was inflation problem. US, India, everyone was going through massive inflation, which means price increases. So the understanding was that, hey, if we increase the interest rate, the inflation problem will be controlled, and the US Fed was able to control it. So they kept the interest rate sideways. So this was a sideways phase. Now we are going structurally in phase 3, where the interest rates are being brought down. Now comes the second data point, and this is a chart that you can refer to, right? I will take you through it, that what ends up happening when interest rate cuts are instituted. So how does the stock market typically behave 3 months, 6 months, 1 year onwards? So this data has been put by Carson Research, and here are some key interesting points I will take you through. So for example, if you consider next 3 months after interest rate cuts, what ends up happening? Then typically speaking, in 3 months time, the chances are that the stock market, or there is a 74% chance that stock market goes up. Similarly, on a 6-month basis, again, there is a 74% chance that the stock market goes up. And there is almost a 100% chance that in the next year, the stock market will continue to rise. So this is very healthy data. Now add to this the fact that we are considering the all-time high when the interest rates were instituted. So if you check the NASDAQ here, so this is the US or one of the US indices. For example, in India, we have Nifty 50. Similarly, in the US, we have NASDAQ. So you can see that NASDAQ is almost at its all-time high. Similarly, S&P 500 in September, it made its all-time high. So if we go back to our previous chart that we were speaking about and just reorganize that commentary, what you would notice is that this Fed cut, which is about to happen on 17th of September, and maybe it's out by the time you are watching the video. So here what it says is that S&P 500 returns after Fed cuts within 2% of all-time high. So we are looking at the correct data set, because in the US, the markets are already at an all-time high or near its all-time high, and this commentary or this historic data is very well aligned. So long story short, if I just have to quickly summarize and give you a key takeaway here, the key takeaway here is that, see, on a 1-year basis, the market look very, very positive. So basically the market is already at an all-time high. Many of you would be thinking that, you know what, should we invest? Should we not invest in the US stock market? I don't know, it's your call, but the data tells us that on a 1-year basis, typically whenever interest rate cuts happen, even near all-time high, the market still rallies. So then comes a natural question that, okay, why is it that US Fed is doing an interest rate cut? Because the market is already quite aggressively jumping up. So what's the need, right? So there are 2-3 reasons. So I'll just quickly take you through the basics of interest rate cut, what it exactly means, what it leads to, and why is it that the stock market somewhat positively correlates to an interest rate cut. Okay, so here is a very simple flow chart of why interest rate cuts are done and what is the macroeconomic impact of an interest rate cut. So the meaning of interest rate cut is, and a very simple example to understand is that, for example, many of us take home loans, and if our home loan is at, let's say, 9%, right, then we will be paying a higher EMI Versus if an interest rate cut happens and your EMI repayment rate falls to let's say 8%, then of course your monthly EMI payment will shrink, right? So that happens largely because of base interest rate, what we are speaking about, right? So long story short, interest rate simply means that, for example, if the rate of lending in the economy was 5%, now it has been brought down to 4%. That system is called as interest rate cuts, okay? Now what it simply does is that it increases the lending activity in the economy. Now again, going back to that home loan example, now if people are being made to borrow at 9% home loan rate, will you borrow more or less compared to when you're getting that home loan at let's say 8%? Now of course, when the interest rate falls, the borrowing activity increases and lending activity increases. So in simple terms, what it does is that it increases liquidity in the economy, because banks will be lending more, people will be borrowing more. Similarly, businesses will be borrowing more. They'll be expanding their corporate balance sheet. They will be making more capital intensive investments in the economy. So long story short, it adds a lot of money to the economy. I'll show you the data also, that how much money is being expected to be added into the economy due to the current interest rate cut in a minute, but let me complete this thought process. So okay, so interest rate, if they get cut, it accelerates the economy. Why? Because it adds a lot of money into the economy. Now this is done primarily for two reasons, right? So one is that basically the projection is that if the economy is slowing down and if the projections are that a recession is going to come, many people panic. For example, here's a video done by Palki Sharma, right, where she created like a lot of panic that, you know, US has gone into recession, UBS has come out with a report, this, that stuff, people sold their stocks. Okay, now that's half-baked commentary. Please don't run by that. You will never be able to invest in the stock market that way. Okay, basically, a recession indicator is a lagging indicator. Recession means that, okay, last 2 quarter GDP data has come out to be negative. The economy is not growing. So the economists will come out today and then they will say that, hey, you know what, now we are in a recession. But what led to that announcement was the slow growing economy for the last 2 quarters. So that is historic data. That is Baba Azam ka data. This has got nothing to do with stock markets. Okay. What is Fed interested in or government interested in is the slowing down of GDP. That's a forward-looking indicator. So what they try to do is that they try to manage policies sitting today, this month, thinking that, okay, growth is now slowing down, so we need to avoid recession. What can we do? So we need to push in more money into the economy. How they can do it? Well, by cutting interest rates. So long story short, in order to avoid a recession, the governments need to take steps now. So the US government has started to take steps now because they think that the economy might slow down. So in order to avoid this recession, they are already cutting the interest rate, because it doesn't work like a switch, right? That you open the switch and the light is on or fan is on. It doesn't happen so fast. Basically, you have to start making the moves right now in order to avoid a recession 3 to 6 months down the line. Okay. So this seems like a recessionary cut because the estimates were that the US economy might slow down. The unemployment data. So here is the unemployment chart. You will see that it's spiking. This month has come out to be a negative month in terms of net employment created and the total unemployment rate spiking. So as a result, in order to avoid this recessionary type of situation, the US government is instituting a rate cut. This is part A. Part B is that sometimes what happens is that the economy is growing at an okay pace. There are no concerns of a recession and all that stuff, but the growth is slowing down, right? So as a result, what the government then does is that, okay, if we don't cut the interest rate, then we might run into recession subsequently. So what we need to do is that we need to maintain a growth rate. So they do like growth rate forecasting. So to maintain this growth rate, they cut the interest rate preemptively. So what is happening right now? Is it like clearly 1 or clearly 2? Now, I don't know. Honestly, even Fed does not know. But what they are trying to see is that, see, they can afford to cut interest rates right now and therefore they are cutting it. So I hope that this point is clear, that how interest rate cuts actually happen. What is the point of cutting interest rates? Now let me move to section number 3, where I will explain you how much money will be added into the economy due to this current interest rate cuts, which is being projected now, and how it will impact different asset classes, because this will help you reorganize your portfolio sensibly. So first things first, in the US, the impact of interest rate cut would take place in the money market, and approximately $7.6 trillion of wealth will be unlocked due to this interest rate cut. It will flow across equity, bonds, and real estate. This is being estimated. These are not my estimates. These have been prepared by economists, by analysts. So I'm just helping you understand the data points. Second is that US is not going to be the only beneficiary of a US interest rate cut. Other countries also benefit. So approximately this much amount of global assets will be unlocked, or more money will be pushed into the economy, more borrowing activity will increase. So this is again good news, right? Then comes the third point, which is real estate. This can't really be estimated in a dollar value, but long story short, at least we can assume that there is going to be a direct impact of $7.6 trillion into the economy. Now this is wonderful news, because if more money flows in, almost everything goes up in value. And this is the precise point why I was telling you that whenever interest rate cuts happen, typically speaking, over the next 1 year, almost everything goes up, right? Right from gold to silver to bonds to equities to real estate, everything goes up in price. Why? Because the money deflates. Okay. So now let me present a point by point commentary on 4 or 5 assets that you might be interested in. I'll give a very quick commentary on these 5-6 points, right? So let's start with US equities. Now, if you take a look at US equities, what you will notice is that the US stock market, especially NASDAQ composite. NASDAQ, basically there are 2 indices or 2 major indices in the US. One is NASDAQ composite. This is primarily a tech index. So when you buy NASDAQ composite, you're buying tech index. If you're buying S&P 500, you're taking a broader exposure of 500 companies in the US. So this is more like Nifty 500, right? So both these indices are right now at an all-time high. Now, can they go higher? So the answer is yes, this can go higher, right? And this rather should go higher. So I'm expecting a 12 to 13% CAGR by next year, right? So I'm not expecting any magic. If you look at S&P 500, it should go up by like 12%, right? Next 1 year. NASDAQ typically grows by 15-16%. So I expect similar growth rate. Now this is being done on projections of corporate earning, because if you just simply go and study the valuation of S&P 500 and NASDAQ, what you will realize is that the PE ratio of NASDAQ, S&P 500 is above its historic average. Now, which means what? That the price is really crazy right now. Okay. Now you'll say, yeah, then if the overvaluation ho gaya, can it fall? Can it not fall? See, guys, I mean, in the short term, anything can happen. Okay. That's not something that I can really control, right? But what we are looking at the macro data is that the earnings will improve. The corporate earnings will improve. So I showed you the data point that $7.6 trillion of wealth will be unlocked due to interest rate cuts. Now, who do you think get access to this wealth or majority of this wealth? Well, it's these type of companies which make up NASDAQ composite index or S&P 500 index. So this money flows into earnings growth, right? And as a result, the PE should be sideways or it will come down, right? So as a result, I'm saying that, okay, net, this equation looks like that it will be maintained. So therefore, US is still a good economy to invest. I'm not saying that bulk buy the market right now, but if you're running SIPs, if you're buying high quality stocks, for example, I recently added Duolingo, I added ASML, I added Novo Nordisk, I added a bunch of high quality healthcare companies. If you're looking to add decent companies on a drawdown, great market to invest right now, no problem, right? Over a 3 to 5 year, it's a very investable market. Now people turn around and then they start like, bashing me that, okay, you are saying like good things about the US market, but the US dollar is falling. Don't become a macroeconomist, okay? For the last, whatever, like 2-3 years, problems have been going on in the US. A lot of trouble has been there in the US. Gold is rising and all that. But what about like US equities? Have they stopped performing, right? So you yourself take a look. So here is the data point after this dip. Okay, so here is the US market. So it has gone up by 30-31% in the last, how many months, right? In the last 4 months, it has gone up by 31%. Okay, fine. What about like since the start of the year? So this is where we are at the start of the year. It has still gone up by 10%. Compare this to Indian market. Indian market is at like -1% or 0%, right? We are not even adjusting for US dollar strengthening, right, compared to INR over the last 2 years. So long story short, US assets, for example, US stocks, US bonds are still high quality. No one, even China, does not come close to being investable. It is still an alpha market, right? I mean, all of us can have our doubts. Yes, US is going down. Maybe in like 20 years, 30 years, it will come down. But that change does not happen like, in like 5 years or 6 years, okay? So it's okay. You can continue to own high quality companies. Companies like Nvidia, Google, they are going to perform well. So this is the bottom line there. What about Indian markets? So, okay, good news, right? So if you look at the Indian market, if you just consider this, now will this bounce back due to interest rate cuts? My short answer is hopefully yes, right? I don't know how fast this will bounce back, but I see an upside of 13-14%, right? This, if you just draw the technical channel, do a quick technical analysis, this is good. And also it is on a wave down pattern, right? So this is wave up, this is wave down, this is wave up, this is wave down. So good time to buy from that angle. I have already built little bit of swing positions on India market. I was sitting on a lot of cash for the last 1 year. In my community also, I have explained it quite aggressively why I'm doing it. In case you are a serious investor, again, my push would be that join my community. You will learn a lot of high quality investing. I am an actual investor. I put a ton of my money into the stock markets. I'm a practitioner, right? So I'm not just coming and giving like random talks, podcasting and all that BS, right? I'm actually putting my money on the line, learning things and teaching my community how to do the same, right? So long story short, this is a good swing trade. India is not an investable market. We do not have growth levers, right? This is great, right? I mean, we put money here, right? Exit here, something like this, make like our 14-15%, get out, figure out the next trade. Even Nifty IT is a good trade, right? So yeah, so I mean, I think these are good options there. They should benefit through interest rate cuts. Maybe it will take 3 to 6 months. My estimate is that by December, we will definitely see like a 1 mini rally, right? And I would try to, I'm already timing it. I've already built position on it. Okay. So this is 2. What about alternate assets like Bitcoin, silver, gold? Silver I had already purchased, right, on my portfolio. It is already up like 25-30 odd %. It is doing really well this year. I had not purchased gold, right, because I buy Bitcoin. So now the point is that you should consider all these 3 assets together: silver, gold and Bitcoin, right? What people miss is that these are alternate assets, right? And here you should consider entire alternate asset class together, right? So, okay, so let's look at again like interest rate cuts and its relationship with gold, silver and Bitcoin. So we are looking at the last 1 year window, that in the last 1 year, some interest rate cuts have happened, right? And since then gold has rallied in a 1 year time frame by 42%. Okay. Now, if you look at silver, again, it has gone up by 40%. Now, what about Bitcoin? Well, Bitcoin in this run up, in this block, has gone up by 111%. So very similar gains, right? It's not as if that between gold and silver, there is much to pick. Now, what about like 2020 interest rate cuts? Because in 2020 also, interest rates were dropped dramatically because the economy was struggling. So gold had given 9, silver had given 72 and Bitcoin had given 525. Okay, so this is again like, I mean, I would say Bitcoin wins, but silver again wins here. Okay. 2019, again, there was an interest rate cut. So gold had given 37, silver had given 27 and Bitcoin had given -9 because usse pehle bahut rally ho gayi. Long story short, you can create, like, I mean, I'm not pushing that you should buy gold or Bitcoin or silver, buy whatever you like, okay? These are alternate assets, so it doesn't really matter, right? So what I typically do is that you just look at the levels. So right now, gold has run up quite a lot. So from a valuation perspective, gold has become really high, right? I mean, I will not try to touch gold right now. If I get it on a down low, maybe I'll buy it. Bitcoin is consolidating. I have already put another little bit of bulk money onto Bitcoin. I think over the next 1 year, there is a good probability that it will do well, right? So this is good. Silver, I'm not buying aggressively, but there is one quick point that you need to know about silver. And this is called as gold to silver ratio. Now, typically speaking, now these are metals in a way. So if gold is going up, silver should go up too, right? And a ratio should be maintained. Now, there is a massive divergence in terms of gold to silver ratio. Now, historically speaking, if the gold to silver ratio used to be 2:1, right now, because gold prices have gone up dramatically, it has become like 3:1. So what is the likely scenario here? Well, two things. Either silver is going to go up or gold is going to come down, right? Over a 5 to 7 year basis, right? So therefore, right, I would say that I'm slightly more bullish on silver compared to gold right now if you want to put money. Now, of course, this thesis can change depending on how fast the prices rise for silver, BTC, etc. So you could consider building an alternate portfolio here. On top of this, there are some sectoral themes. For example, healthcare is likely to do well from this point. Real estate stocks are likely to do well. Maybe not in India. Real estate stocks are going to do well because they have already given a massive rally. But with interest rate cuts, affordable housing stocks are going to do well, right? So these are some themes that you can pick. In case you are looking to sell your real estate, the next rally could be a good rally for you to exit. So long story short, and just quickly summarizing the video, number one, interest rate cuts are healthy for the stock markets. Typically on a 1 year basis, the markets almost always rallies. Bunch of assets, right from gold, silver, Bitcoin, US equities, Indian equities, they typically do well. Number three, you have to make a decision of investing versus trading. So US is a better market to invest over a 3-5 year because there are real growth triggers, right? Especially which are coming from data centers, AI, high quality companies, semiconductors. In India, we don't have that. We are struggling for growth. But India is a great trading market. Make your quick money, rotate it, move to other assets. Okay. Between gold, silver, Bitcoin, I've already explained how you can potentially look at it as one lump and accordingly restructure your portfolio. In case you enjoyed the video, do consider subscribing and give it a like, and I'll see you soon.